can start now, Kalyani. Guys, all the best.
Thank you.
All the best, everyone. All the best.
Right.
Hello, everyone. We'll wait for a few minutes to start the presentation. We'll let all the participants settle in. We'll start in a few minutes.
काम करेगा नहीं हम लोग ब्राउजर कैसे डाउनलोड करा ठीक है ना
Hello, everyone. Good evening to the ones who have joined us from India and good morning to the ones who have joined us from US. We welcome you to our webinar on US tax updates and planning opportunities for corporations. Today's webinar is led by Shishir Lagu, who is the partner of US Tax and Advisory Services at KNAV, and our US tax experts, Kavit Sangvi, Dharmish Desai, Shrenik Kotak, and Pratik Manani. If any of our participants have any questions during the webinar, please use the chat box and we will take your questions after a presentation. Thank you. And Shishir, over to you.
Thanks, Kalani. Good afternoon, everyone. Hope all of you are doing well and more importantly, keeping safe. 2020 honestly has been a year to forget, or maybe at least remember for all the wrong reasons. Pandemic literally took toll of the lives, the health, and the businesses. The US GDP declined by 3.5% in 2020, which was the biggest dip after 1946. It was the first time after the Great Recession of 2007-8 that US really had a negative growth. Having said that, per the report of Jeffries, which came out in early March 2021, US is kind of recovering and it has already reached to about 85% of where it was 1 year back, which is an extremely positive news for all of us. And we feel that the slowing rate of the COVID cases and the rapid pace of vaccination would kind of only improve the economy further. During this last 1 year, when US was going through this tough time, the US Congress did make a lot of effort to help the businesses through various incentives, various grants such as the PPP or the ERC and so on. And the taxpayers really appreciated those benefits coming their way. But at the same time, they need to be mindful that they have the tax implications as well. Nonetheless, there were other changes also which happened at the federal and state level, which the taxpayers and the tax consultants must be mindful of as they step into the 2020 tax season and plan for the future tax years. One more important event which happened in 2020, which all of us know, is the way Joe Biden and his Democratic colleagues dramatically came into the power. With the change of power comes the change in tax laws as well. So one must be mindful that there can be quite a lot of changes to the tax code. Maybe in 21, maybe in 22, we don't know at this juncture, but definitely there can be some changes down the way. We will be covering some of these key developments in our today's session. Today I have been joined in by my colleagues, Kavit Sangvi, who is a senior manager with the federal tax team, Shrenik Kotak, who is a manager with, again, the federal tax team, Dharmish Desai, who leads our SALT practice, and Pratik Manani, who leads our transfer pricing practice. So we have four fantastic guys who will be sharing their expertise and their views on the different aspects, as when it comes to the US taxation. First, I would like to move to Kavit Sangvi. So Kavit, my first question to you is, we discussed, I just briefed about these incentives, right? And PPP was one of the very important initiatives which was taken by the US Congress. As per the report of SBA of 21st March 2021, close to $718 billion of loans have already been disbursed and 88 billion worth of loans still to be disbursed. PPP had its own set of tax consequences. There was quite an uncertainty about the taxability thereof. So I would like you, Kavit, to kind of brief our audience about this PPP round 2, which is a new round of funding which came as a part of CAA, and also the federal tax implications associated with the PPP program.
Sure. Thanks, Shishir, for the introduction and also, throwing some light on the PPP PPP loan. So yes, the Paycheck Protection Plan, which was introduced as part of the CARES Act, it was one of the great initiatives and that attracted interest from a lot of businesses and taxpayers because it offered significant benefits in this in the time of pandemic. And so everyone was quite interested on who is eligible, who is eligible for forgiveness, eligible for applying to the loans, and a lot of ambiguity also surrounded around the eligibility and forgiveness aspect. Though now there is much more clarity on it, the forgiveness applications are being accepted. So and now they have also brought in this PPP version 2, I would say. So throwing some light on the eligibility, though more or less the same, but some aspects to some that are different is that the businesses which were eligible for the PPP1 are eligible for the PPP2 loan. Also, they need to have some reduction in gross receipts for 2020 as compared to 2019.
How you make sure that you are extremely gently spoken?
And also the employee threshold, which was earlier 500, has now been reduced to 300 under this new PPP. And the due date, last week itself, the due date, which was earlier March 31, has now been extended to May 31. So the businesses which had not yet thought about or not clear whether to apply or not, they are now have further 2 months to think about it and apply for the PPP loan. Another important aspect is the affiliation rules, which there was a lot of ambiguity, and now it is clear that the affiliation rules will continue to apply to the PPP. The worldwide entities need to be considered for the employee threshold and also for the gross receipt reduction in the new PPP loan. Important aspect to consider now is the tax impact. While this gives a lot of benefit, what the ambiguity was around the tax impact of the PPP proceeds. So the CARES Act provided that the forgiveness of PPP loan would not be considered as income for tax purposes. But what was not clear was the deductibility of expenses that were incurred out of the PPP proceeds. So IRS then provided a guidance that the expenses incurred out of PPP proceeds would be disallowed for tax purposes, which led to a lot of opposition from the businesses because that did not seem to be the intent of the Congress or the CARES Act. So as part of the Consolidated Appropriation Act, while they introduced PPP2, they also clarified that the expenses that are being incurred out of the PPP proceeds will now be allowed as deduction, which brings in a lot of relief for the businesses and taxpayers. So I guess that's about it on the eligibility and the tax impact.
Sure. Thanks, Kavit. So Dharmesh, over to you now. And we all know, right, that each state is unique in itself and it may or may not necessarily conform to the federal tax provisions. And PPP is one of it. So whilst we now understand from Kavit that at a federal level, it's almost like a tax-free grant, which is there. So your thoughts with respect to the state tax treatment of PPP? How is state really viewing PPP?
Thanks, Kavit, for explaining the federal tax rules. Thanks, Sushil. Yeah, the federal tax position is almost well settled. So while most states have come up with a conformity that they will adhere with the federal tax treatment, but there are few states, namely few states who have either not forgiven the loans and treated them as taxable. These are the states which follow the CARES Act and have a prior conformity, who do not conform to CARES Act and have a prior year conformity, or because they would deny the deduction for the expenses paid towards the proceeds of forgiven loans. These are generally those states which conform to the provision of CARES Act but do not conform to the CAA law. So there are around 12 states who do not yet conform to PPP loans.
Okay, so I mean, there are still substantial states. I mean, 12 states, what I understand, are the ones. So if someone is like, because I understand California as one such state. So if we are having a situation where there is a PPP, a substantial PPP, which may be a tax-free grant at a federal level, but it may still be subject to taxation in California. So I'm sure the taxpayers will have to be mindful about the state implications, especially if they have significant apportionments in the states which do not conform to the federal PPP treatment. while determining their tax positions in 2020. I again move on to you, Kavit, and just like PPP, just like PPP, there was another important initiative which was brought by the IRS and which was with respect to employee retention credit. It came as a part of the original CARES Act, but was subsequently enhanced or modified through the CAA or the ARPA. So I'm sure this is another provision which is giving huge benefit to the taxpayers, especially given the fact that it's a refundable credit. So Kavit, can you share your thoughts in terms of the employee retention credit and what it means for 2020 and even for 21?
Sure, absolutely. So yes, so Sushil, as you mentioned that this was introduced as part of CARES Act, and then recently there were few modifications and also extending it to 2021, entire year 2021 itself. So the modification that was brought in has actually interested a lot of taxpayers, and mainly because earlier ERC was not eligible for the taxpayers who had opted for the paycheck protection plan. And as part of the modification, now it has been provided that those who have applied for PPP are also eligible to claim ERC, and that too retroactively. So the taxpayers can now just go and amend the 2020 payroll tax returns and claim ERC for prior quarters. So this comes as a huge benefit for the taxpayers in this time. This is one of the most important changes that has been brought about. Other changes, I would say some other provisions on this is that the ERC credit has now been increased to 70% for 2021. When I say 70%, it's 70% of qualified wages, which was 50% of qualified wages in 2020. The maximum limit of ERC per employee has also been increased for 2021, which is 28,000 per year per employee, as against 10,000 in 2020, which was 10,000 per employee per year. So again, this has led to a significant increase in the benefits of opting for the ERC. However, there is a ambiguity that still persists, as similar to PPP, where we received clarification, but for ERC, we have not received clarification on how the affiliation rules will apply to the taxpayers, whether the worldwide group need to be considered for the count of number of employees, also for the gross receipt reduction, whether everything needs to be considered, whether when it comes to government shutdown, how does that work along with the affiliation rule. These are all aspects which still there is a lot of ambiguity, and there are different views available on this. Some views are that the foreign affiliates in entirety need to be considered for gross receipts, for employee threshold, everything. While another view is that only the gross receipts pertaining to US, that is effectively connected income to the US trade or business, and the US employees of such affiliated group need to be considered. So there is no clarity from IRS. These are just different views available based on the interpretation of various code sections and interaction with other code sections. So from KNAV per se, we believe that only the gross receipts pertaining to the US trade or business and the US employees need to be considered. But again, this is just our view, and we need to wait for the IRS clarification on this. So all in all, a very careful planning and analysis need to be considered while analyzing the applicability of ERC to a lot of businesses, and also as against the reduction in gross receipts, which can be pretty straightforward. But the government shutdown rules, what kind of activities are prohibited and what kind of orders are considered for shutdown, they need a very careful analysis. And that is where this ERC credit may become really relevant and really important for the businesses. And I guess, this is on the mainly the eligibility. Now on the tax impact of ERC, not much of a tax impact, just that the whatever credit has been claimed, that credit will be considered as a reduction to the payroll expenses claimed as deduction. So nothing more than this on the tax front, I would say.
Sure, thanks, Kavit. I guess the two words which you kind of used the most in this whole discussion and rightfully used was benefit and ambiguity. So whilst there is definitely a benefit which is available for the taxpayers, it does come with an ambiguity, especially when it comes to the foreign affiliation rules. And that's where a careful analysis of the eligibility for ERC and the criteria associated with ERC is extremely important and can have a long way in terms of gaining that benefit. Sure. So with that, I move to Shrenik. So Kavit mentioned about the tax implications for PPP or the ERC, which are two important provisions which can impact the 2020 tax returns of the taxpayers. But I'm sure there are other provisions as well, which the taxpayers and the tax consultants will need to be mindful of as they step into the 2020 tax season. So quickly over to you, Shrenik, for 2-3 important provisions which you feel can have a bearing on the 2020 tax return.
Sure, Shishir. Thanks, Kavit and Dharmesh, for briefing us about the tax impact of PPP and ERC. So definitely there are certain benefits which will phase out post 2020 tax year. And the two of the important provisions which will phase out, which I want to highlight, is regarding the net operating losses. And another one is the 163, the interest expense disallowance. The first one, which is regarding the net operating loss. So as you remember, so this was one of the major change. It was introduced back in 2017 in TCGA. So it was provided that in TCGA, the taxpayer will be able to utilize only 80% of the losses which are generated post-tax year 2017. However, it was provided that under the CARES Act that this restriction will not apply to the losses which are generated from 2018 to 2020. So this was a relief basically which was provided to the taxpayers because of the COVID situation. So ideally, the 2020 now will be the last year to utilize the losses which are generated post 2017 to be utilized at 100% capacity. Another point revolving around the net operating losses is the carryback of losses. But as you are aware, and we have also previously covered in our webinar, carryback of losses was reintroduced by the Congress for the losses which are generated during the tax year 2018 to tax year 2020. This was indeed a good benefit which was provided under the CARES Act, wherein the taxpayer basically can encash the higher taxes which are paid in a prior year. So as you are aware, right now the tax rate is 21%, and earlier it used to be 34-35%. There is a delta of that 30%. The taxpayers can carry back the losses and encash the taxes which they have paid at a higher rate, rather than carrying forward it and taking a benefit at a 21%. So basically, this 2020 tax year will be ideally the last year which will be eligible for the carryback of losses. So if you're a taxpayer who is following a March year end, then the last day to file this carryback claim will be 31st March 2022. Now, since we are at a year end, let's look at the tax accounting aspects for carryback. So companies carrying back losses from the tax year 2018 to tax year 2020 also need to weigh the impact of tax rates in the carryback year to which the losses are applied. So since this losses which are generated in this 3 tax year would have created a deferred tax asset at a 21%. So now, if these NOLs are carried back to years before 2018, the resulting refund would be a tax year when the tax rate was a higher rate, which is the 35%, which will result in an additional cash tax saving. Hence, the companies need to recognize a higher DTA on account of such potential benefit arising to the company. That was all about the net operating loss. Now let's come to the 163 interest disallowance. As you are aware, any net business interest expense which exceeds 30% of the tax EBITDA will not be allowed as deduction in that year. So this limit of 30% was increased to 50% in CARES Act for these 3 years, 2018 to 2020. So the tax year 2020 will be the last year for taxpayer benefiting from this relief. So the taxpayer basically who has a higher net business interest expense, bear in mind, and will have the impact from the next year. That's all, Shishir, from my side.
Thanks, Shrenik. I think you discussed about the net operating losses and the arbitrage of 13 to 14% arising out of the carryback. And I'm sure a lot of our clients is availed of that benefit as well. But there is also an expectation, which is coming out of the Biden's tax plan that the tax rate may go up to 28%. We don't know why. When it will be 22 or 21, we don't know. But there is definitely an expectation in terms of the increase in the tax rate. So 2020 kind of becomes a very critical year where it's a last year for a generation of NOLs to carry it back, or whether to defer the deductions into the future years, so that instead of the current 21% gets taxed, it's taxed currently at a 21%, whilst the deductions are available when the tax rate increases. So this is a very, very crucial year. So any aspects which you kind of think of, Shrenik, which can help the taxpayers plan around this, expense deduction in a much better fashion to see whether they can claim those carrybacks and get a better advantage.
Correct, Srishant. So, there are a few ways through which, taxpayers can fast track the deduction for some of the items. So, let me highlight 3 to 4 of the items for that. So, first one is about the debtor collection. So, as you rightly said at the beginning, most of the corporations are hit by this COVID thing, and even their client are hit by the COVID thing, which will in turn, client will be facing in a issue in a debtor's collection. So basically, and also, there will be also negligible chance to recover the money. So in consultation with the company's auditor, taxpayer, if absolute certain about the non-recovery of a debtor, can claim a deduction of a bad debt in a financial as well as on a tax return. However, it should not be a mere provision of the bad debt. Another point can be of a prepaid expense. So if the conditions which are provided under the Internal Revenue Code, then through the change of method of accounting if required, the deductions of the prepaid expense can also be claimed by the taxpayer. The third point can be of an inventory write-off. Basically, the taxpayer who are in a business of a manufacturing or a trading of goods can analyze the inventory at the year end and consider the writing down of a subnormal goods. This is very common practice in pharma industry. However, the taxpayer should note that it should not be a mere provision of an obsolete inventory, as it will not allow them a deduction, and it should be an actual write-off. The last point, which is a very common, and I'm sure most of the attendees would be facing that, adjustment in the tax return, is the payroll-related liabilities. So, as you are aware, payroll-related adjustments are made on the tax return if the liabilities or the provisions are not paid within 2.5 months. So, the taxpayers can basically do the assessment of their internal processes and then complete these processes within 2.5 months from the year and make the payment by this due date in order to get the deduction in 2020 itself. So this can be some of the ways to accelerate the deductions in 2020 tax year. However, even if after this fast tracking the expenses, if a taxpayer is not coming to a taxable situation, and as you rightly pointed out, a taxpayer should analyze whether this expenses should be deferred to a future years where the President Biden will increase the tax rate, or whether to take a deduction right now at a 21%. It will be on a case-to-case basis for each taxpayer, but it is an important decision to make for taxpayers.
Sure, Shrenik. So, what I can sense is that the taxpayers can definitely, so 2 important things, looks at provisions at the year end, what can actually be considered crystallized, what can be claimed as a deduction in 2020 itself, maybe one way of looking at it. Similarly, they can also look for legitimate opportunities to kind of accelerate deductions from the change in accounting methods as well. So the change in accounting method can be done for tax purposes. It can be done, if it's an automatic route, it can be done along with the tax return. So they still have this window to kind of change the accounting method to see if there are any accelerations which may be possible, which can help them on their 2020 tax position. Sure. With that, again, coming back to Kavit now. So you mentioned about PPP, you mentioned about ERC, but another provision also which was extremely important, which came as a part of CARES Act, was deferral of the employer share of payroll taxes. That not only just help the clients from the cash flow perspective, but I understand that they come with its own set of tax implications as well. So I would like your thoughts, Kavit, in terms of what are the tax implications you sense out of this payroll deferral?
Yes, absolutely. I guess this is also one of the important measures that were announced as part of the CARES Act and provided significant cash flow benefits to the businesses because employer taxes form a significant part of the cash flow and it offered great benefit to the taxpayers. So yes, that on the tax front, it needs to be taken care of on that how it impacts the businesses from income tax perspective. Because though it offers cash flow benefits, it does not necessarily mean a deduction for tax purposes, just as it is accrued in the books. Because generally for the payroll taxes, the condition is for claiming deduction that the payroll taxes need to be paid within a period of 8.5 months or before the filing of the tax return, whichever is earlier. So just for example, for calendar year taxpayers, the original due date for corporations is April 15 and the extended due date is October 15. So if the employer has deferred the payroll taxes, the due date for payment of those for 50% of that is December 31, 2021, while the tax return would be filed by October 15 and the 8.5 month period ends on September 15. So if they do not pay by that period, entire amount would be disallowed for tax purposes. So a careful consideration by the time of filing extension needs to be considered whether they are planning to pay or not. Because if not, then they will have to consider that and pay the taxes right away because the extension is only for the filing of the tax return and not for the tax payment. So similarly for March end taxpayers, the original due date is July 15 and the extended due date is Jan 15. So the 8.5 month period for them ends on December 15. So yes, for a March end taxpayers, they can consider paying 50% before December 15 because the due date is of payment, the actual due date is just 15 days post that. So they can consider doing that. But yes, then again, for balance 50%, they need to take into consideration and make a decision. Kind of a cost benefit analysis needs to be done. So that's on the tax implication. I would say yes, and additionally, I would say on tax accounting front, this is pretty straightforward. And similarly, that we do for all payroll related items or any temporary difference. Since if we are going to disallow this and claim deferral, then the deferred tax asset need to be created for that because this will be allowed as deduction in future years.
Sure, Kavita. Don't we look at it also as an opportunity where, of course, if you are short on your current year tax payments, definitely you would want to kind of claim a deduction on 2020 itself. But if someone also looks at it in terms of just an expectation, because we don't know about it, but if there is an expectation of the tax rate increase, especially let's say for 2022, in all likelihood, the deduction, this can act as an added deduction in 2022 as well. So the taxpayers need to carefully plan whether they want to have a deduction at current date or whether they are happy kind of deferring it in the future years. Dharmesh, now I again come to you, and like Kavit and Shrenik, gave their inputs with respect to some of the federal level changes in 2020. I'm sure the states are also kind of constantly updating their laws, both on income tax as well as sales and use tax front. Sales tax has been kind of more aggressive post the Wayfair decision of June 2018. But income tax is no behind. The states kind of keep on continuously making changes. So I would like you to, share your thoughts on some of the key changes which one can encounter when preparing the 2020 tax returns.
Sure, Shishir. While there have been major updates at the federal tax regime, but for state tax purposes, what we have observed that the states have generally followed a trend for the past 2-3 years. So I'll give you the trends by example. So for example, in service revenue apportionment, there has been an inclination by most of the states to adopt market approach methodology. while states like New York and New Jersey moved to the market approach in the previous years, and quite a lot of other states as well, the states which have currently moved to market approach are Hawaii, New Mexico, North Carolina, and Vermont. There is also abnormality. There's one state which has moved from pro rata approach to preponderance, that's Kansas. Other than that, the states have been following the same trend. Even for apportionment percentage, what we have seen that the sales have given more greater importance to sales factor. So be it following single sales approach or be it giving higher weightage factor. For example, the state of Tennessee right now follows has given 6 weightage factor to sales, whereas they give 1 each factor to payroll and property. So this has been the general trend, and in the current year as well, there are 2 states which have moved from a 3-factor approach to a single sales approach. They are Delaware and Missouri. While we come to the state tax rates, there has not been any major change at the state level where reduction of state taxes has been concerned, but we have seen a gradual decline in the sales tax rate. So there are 3 states like Colorado, Indiana, and New Hampshire which have marginally reduced their tax rate, but there is one state which is Missouri, and one of our clients would be happy with it. They have reduced the tax rate from 6.25% to a mere 4%. So this has been the major trend. Indiana, for the past 3 years, has been reducing the tax rate, and this is the last year that they will be reducing their tax rate.
Sure. Thanks, Dharmesh. Pratik, I move on to you now for my next question, and which is to do with transfer pricing. That 2020 has been the year of disruptions, and which led to a lot of corporates modifying their intercompany pricing arrangements and so on. So, what are your views in terms of this whole change in terms of the transfer pricing, and how best or what kind of defense is required to safeguard the taxpayers' interests?
Sure. Thanks, Joshi. So as rightly mentioned, certainly, the 2020 was not the year that we were expecting, and there were a lot of uncertainties around businesses. So due to government imposed restriction on business activities, when there was disruption in the supply chain, then many employees were stuck in the foreign jurisdiction. They were not able to go back to their home country. There was lack of demand for the product. So overall, as a result of this, many companies may end up reporting losses, and certainly, their intercompany pricing would also get impacted. So, but fortunately, the businesses are recovering now, and but there are certain tax and transfer pricing aspects that needs to be considered, and some of them are, so first one is a value chain reorganization. So in order to minimize the risk, many entities had, shifted their function from one entity to another entity. So as a result of this, there might be change in value chain reorganization, or the business restructuring might take place. So one need to assess whether there is any need to relook at the transfer pricing arrangement, or whether any exit charge is required. So this would require a lot of a lot of analysis whether TP can be modified or not. Another major challenge for M&A is compensation for low risk entities and captive service providers. So while the distributing entities are incurring various expenses, at the same time there is no sales happening. So the real question is, who should bear this cost? Whether the manufacturing entity should bear this cost, or whether distributing entity should bear this cost. Similarly, in case of captive service provider, so historically, this type of service providers were compensated on a cost plus basis. But now, since the group as a whole is incurring losses, so whether still they can be compensated on a cost plus basis, whether there is any room for reduction in markup is required. So these are the certain questions that we might need to answer. So we might not have a clear answer for all of these questions, but a separate analysis would be required for determining what is the arm's length price. Then next point is intercompany financial transactions. So because of liquidity crunch, so we have seen increasing number of intercompany financial transactions. So as rightly mentioned by Shrenik, so company might face a credit risk because their clients are asking for more time for repayment of receivables, and at the same time they MNEs had to manage their working capital requirement. So as a result of this, there is a increasing number of intercompany loans and advances. So what one needs to see is whether the interest rate that the entity is charging, whether it is at arm's length or not, whether the borrowing entity has a capacity to borrow the funds, what is a credit rating of the borrowing entities. So these are the factors that needs to be considered. Then next one is allocation of cost. So many MNEs have formed a crisis management team to mitigate the risk arising due to COVID-19. So this may require allocation of cost to all the other group entities based on the benefits that they receive. So one needs to be careful here, because what they need to substantiate is that the receiving entity recipient is able to support what all benefits they have received from their parent entity, and how this cost have been allocated, what are the scientific allocation keys that they have used. And next one is so there might be change in functional profile of each entity. So as a result of this, there might be change in TP policy or TP arrangement, so which may require amendment to existing TP agreement. And lastly, whatever position that MNE is adopting, it should align with the value creation and allocation of risk, because entire crux of transfer pricing is based on this principle. I mean, the value creation and allocation of risk.
Sure, Pratik. So I guess the key takeaway is that the contemporaneous looking at the FAR analysis of the companies under the transaction, and whether any changes to them have happened because of the COVID days. I mean, if there have been any change in the functional profiles, etc., and to well document that which is something extremely important from a TP perspective. Over to you, Kavit, again, and my next question. So like I said at the beginning, that with the new administration in the White House and the tax changes expected, Biden and his Democratic colleagues, as a part of their election campaign, had came out with a tax plan, which kind of, I feel that most of the changes therein were unfavorable, and which is kind of fair, because ultimately they are looking at how to finance the entire incentives and the benefits which they provided during the pandemic. So the CARES Act was kind of a $3 trillion, expense. The CAA came in, was another 1.9 trillion. So IRS also, the Congress needs to have the money to kind of take care or reduce the deficit which is arising because of these incentives. So they came with certain plans. It was to do with the tax rate, the AMT, international tax aspects. So whilst nothing is clear as of now, it's just a tax plan, but always important to look into what they are looking at. And Kavit, I would like you to share your thoughts on some of the key 2-3 changes which are being proposed by the Biden tax plan.
Yeah, sure, sure. So I think you rightly put it that most of the provisions that have been brought about might seem unfavorable to the taxpayer, and rightly so. Those are like if we compare with the Trump administration, which have brought in us a lot of benefits, along with some other provisions as well. But yeah, there were significant benefits were brought in. So now, whatever provisions are proposed to be changed, it is going to be unfavorable. But as you put it, they need the money for the government needs money to fund to recover the incentives that they've given and to run the economy. So yes, I think it's fair on their part to bring in such proposals. So one such most important and most simpler one is that corporate tax rate, which was earlier reduced from 35 to 21%, is now again proposed to increase to 28%. We might have to wait for the entire process to get over, like whether they are able to increase to entire 28% or there's some trade-off and it's kept at 25%. Yeah, because there had not been a clear majority in the Senate for them to bring in the clear changes. So, but as it stands today, it's 28%. Along with that, they have also brought in an offshoring tax for taxpayers who are offshoring their processes and services outside of US. A 10% surcharge is being applied on the 28% tax, which takes the overall tax rate effective to around 30%. So again, unfavorable for businesses who are getting their work done from outside US. And then I would say that alternative minimum tax. Yes, this was repeated.
Kavit, sorry to interject you here because that's a very important point you brought in about the 10% offshoring penalty. And my thought on that is it's extremely kind of onerous, but at the same time, I mean, if there is a lot of offshoring which is happening, I'm sure Congress realizes that the arbitrage between the labor cost associated with offshoring and a 10% penalty, still the latter is going to be less. So, the taxpayers may still go with this offshoring model, but at least IRS is getting the 10% additional surcharge. But to my mind, the record keeping is something going to be extremely onerous. Of course, I mean, nothing is still a law and regulations are far beyond that. But how do you really even determine what my offshoring profit is? I mean, if US is a completely an entrepreneur entity, if it is doing a lot of work within the US also, and then offshoring some portion of the work, how does it even really determine what profit got generated out of the offshoring activity? So a lot of clarification around that will be required if at all this comes in. Secondly, from a transfer pricing perspective, and we had a similar situation when BEAT regulations came in because we have so many clients, right, where the entire work is happening in India, let's say, and what US entity is merely doing is a sales marketing front ending. But from a business exigency perspective, the contracts are entered into by the US entity. So from a GAAP perspective, the revenues are reported into the books of the US entity, and then the cost of goods sold or the cost of services is reported on the expense side. So now that technically falls within the ambit of offshoring, but what US is retaining is just to say a 5%, 10% margin for the sales and marketing effort. So can someone really consider this as an offshoring and say that, okay, the profits which you are retaining in US will be subject to 10% offshoring penalty? Or whether someone can argue that this is actually a pass-through income for the foreign affiliate itself. And US is in fact not paying anything to the foreign affiliates, but in fact it's earning the marketing revenue. So how you really portray it from a transfer pricing perspective and whether that will stand the defense with the IRS. So I guess there are a lot of questions around this 10% offshoring penalty if in case it comes. Sorry to interrupt, but I felt it was relevant. You can continue, Kavit.
No, absolutely. I think you've given really good inputs. And I would just like to add on one point on the record keeping, which you mentioned. Yes, absolutely. I agree that there will be a lot of record maintenance need to be done. As even in existing TCJA, if I to see for FDI deduction also, there are so many documentation requirements for the foreign sales. and to be maintained, to obtain some evidence. So again, along with that, this becomes pretty onerous for the taxpayers, and we'll need to see how reasonable the taxpayers can maintain such documentation. Okay, so next I would like to highlight on the alternative minimum tax. This was repealed as part of the TCJA, but now again reintroduced with some modification. So it says that 15% of the book income of entities that have book profits of 100 million or more will be considered as alternative minimum tax. So again, this is pretty fair, and they want to tax the bigger multinational companies, and that's how they have introduced the AMT. Next is on the guilty provision. So first of all, the tax rate of 28% will ultimately impact the guilty inclusion. As against that, they've also brought in that the 50% deduction against guilty inclusion, which was being offered in the current law, will now be removed. So earlier the effective rate on guilty inclusion was 10.5%, will now be doubled to 21%. Also, the guilty is now to be applied on a country-by-country basis, which was earlier applied on an aggregate basis. So even that because a lot of low tax jurisdictions were able to get benefit of the foreign tax credit from the high tax jurisdictions at an aggregate level. And it was there might be a minimum tax impact on the guilty inclusion, but now it needs to be seen how this will work for them. Next is the high tax exception, which was introduced last year, and the increase in corporate tax rate will increase the threshold for high tax exception from 18.9% to 25.2%. Again, a lot of jurisdictions might not even fall for the high tax exception regulations.
Sure, I guess, thanks Kavit, and I would add one more point is that whilst you mentioned all the unfavorable aspects of the Biden tax plan, he definitely has the agenda to promote or further promote the Make in America movement. So there are definitely some benefits which are also coming in terms of a 10% Make in America credit and so on, which kind of can be favorable to the taxpayers if in case they decide to operate domestically. If they want to expand their manufacturing facilities in the US, I'm sure there are going to be some opportunities on the credits which are going to come our way. Now quickly, I move to Shrenik, and we are kind of a little short on time. So very quickly, Shrenik, what I want you to cover is, whilst we discussed about 2020 and what we need to look in for 2021. So any major couple of things or key takeaways in terms of what one needs to look at when planning for 2020?
Sure. Let me just cover a couple of the provision which is expected to phase out gradually in coming 2 to 3 years. So, as everyone is aware, TCJA announced some of the real benefits for the taxpayers, and one of them was accelerating 100% depreciation in the first year itself for the properties which are placed after September 2017. So this was indeed a real benefit which was provided to the taxpayer in terms of claiming a depreciation in the first year itself. So this depreciation will start gradually reducing to 80% and 60%, as you can see on the screen. So companies who are planning to invest heavily in the capex in coming 2 to 3 years should consider this point while planning their capex timeline in order to get the maximum benefit. Another point which I would like to cover is for the 163 disallowance, which we previously discussed. So as I said earlier, this taxpayer can deduct up to 30% of the tax EBITDA. So now this from a tax year 2022, EBITDA will be changed to EBIT. And thus companies who have a higher or a significant depreciation expense in book as well as tax will have an impact. So the taxpayer basically who is planning from capitalization from 2022 tax year should keep this point in mind while in their planning. So these are the 2 points, Shishi, from my end.
Thanks, Rene. And similarly, Dharmesh, any trends which you are seeing from a state tax perspective?
Yes, from the state tax perspective, I would believe that the similar trends of states following the market approach methodology and moving to the single sales approach will keep on continue. There are a few other proposals that are in the proposal stage, if you lost. So basically, one of the proposal is where states would want to tax more. They would the current situation is as that they are looking at more revenues, and hence a few of the states like Pennsylvania, Maryland, and Florida are looking to move on to the unitary filing method. Other than the right now, they have been following the single separate filing return, so no combined filing is allowed. In the state of Florida, you are allowed to file a consolidated return, but a combined is in the proposal stage, and we may be required to file a combined return for Florida as well. The other way the states are looking to add more to the revenue is also taxing outside US revenue. So taxing the entities based on a worldwide revenue portion. So the states like California who have the worldwide as a default, and you can actually do an election to file as a water's edge, meaning you will be only taxed in the US jurisdictions. But if this worldwide proposals are in place, if they are accepted, the states would be required to report the entire worldwide revenues, and that would and may increase the apportionment percentage.
Sure, Dharmesh. So I guess change into the market approach, the reporting pattern. So I guess one will have to keep a constant eye on what changes are happening at the state level, and accordingly what it means for the taxpayers. So I guess we are coming to the close of the session now, but I would like to kind of open the forum for Q&A. And when I say that, I mean, I have already received a few questions. So I will kind of, direct those questions. So Kavit, my first question is for you. And that's a very interesting and a practical question, I would say, and that's what we are facing. So it's from one of the audience's participants who is saying that they have applied for the carryback and have claimed the refund. And whilst it was originally claimed that it will come within 90 days, it has been almost more than 7 months that they have filed it, but have not received any refund from the IRS. So what is our experience on that? And I'm sure you will elaborate, but I would say that a lot of our clients are in the same boat as well.
Yes, absolutely. I think a lot of clients are waiting for the refund. As I rightly mentioned, 90 days was the time frame mentioned, but I guess the problem is that IRS is also a bit short-staffed, and there are a lot of applications coming in for carryback. So it's taking time. But yes, we've called up IRS, spoken to IRS on a few of our clients, and they've mentioned that these are under process. So we expect that like gradually now in some period of time, those refunds which are stuck, they might be now released gradually. And considering that a lot of things got opened up, and IRS is now issuing a lot of other notice on any other matters as well. So we expect them to be processed soon.
Sure. Pratik, the next question is for you. And, in your presentation, you mentioned about the transfer pricing, the changes aspects, and more about the documentation. So is there any formal guidance or, something around, from a US perspective in terms of the TP documentation, what the taxpayers must bear in mind?
Sure. So there is no COVID-specific guidance on transfer pricing, but there was a guidance on effective TP documentation last year. So some of the key aspects of this guidance is, the tax authorities, they expect each taxpayer to maintain robust transparency documentation. So this has to be on a contemporaneous basis, and more focus of IRS would be on entities incurring losses. So how well they have justified those losses in their documentation. So whether those losses are due to external factors, or is it due to intercompany transfer pricing policies. Then another major aspect that they need to consider is what all adjustment they have performed while conducting transfer pricing analysis. So what IRS is expecting is that taxpayers should provide rationale for any economic adjustment that they are performing, how the adjustment has been performed, and taxpayers should provide working of this adjustments.
Sure, and as far as statutorily is concerned, Pratik, I'm sure there is already a 482 and penalties under 6662 which govern the TP documentation. And in fact, last year IRS also came with some best practices FAQs on the transfer pricing documentation. So, and also during the recent audits, we are seeing a significant trend towards the transfer pricing and transfer pricing documentation. So, it's strongly recommended for the US taxpayers to maintain a robust transfer pricing documentation from a US perspective, since it's going to be their first line of defense in case of an IRS audit. So that's extremely important. Next question which has come from one participant is, it's a very interesting one. 10% offshoring penalty surtax. Is there any exemption planning on an entity structure to avoid this surtax? Most of the offshore entities on a markup does not have any much profits. I completely I'm aligned with you, and unfortunately this was the same thought process which we were going through when the BEAT regulations had come in. But at least the good part about BEAT was that it was applicable only once the revenue thresholds crossed $500 million, and there is no such threshold as it looks like, at least at this point, for this surtax. But having said that, it's not really about what kind of profits do you retain in that offshoring entity. I understand that it's more of a cost plus markup model, but logically the profits get accumulated in the US entity, and that's what they are looking at, that because of offshoring you have been able to generate higher profits because your cost of offshoring was low. So then the higher profits which you are retaining in the US should be subject to higher tax, so which is a 10% surtax. So again, and even as we look with BEAT, there are no real exceptions as far as whether it's a C corp or whether it's an S corp or whether it's a partnership. So obviously, but like I said, I mean, it's just a 2-line law at this point. It's just a tax plan. Once the law comes in, once the regulations come in, there will be a lot more clarity on that. I'm sure once Biden comes with a new tax plan, or the House and the Senate comes with a new law, we will have definitely a lot more webinars on that topic. But at this juncture, there is a very, very limited information on this. I guess we have crossed our time, but I will take this one last question from one of the participants because I really like this question, and it's to you, Dharmesh. There are this change in the business model in 2020, which led to a lot of employees working from home. And does that create a nexus issue? So they may not necessarily be working from the office state, they are working from the home state. Does that create nexus? Is there a state guidance on that?
Yes, Shishir, absolutely. So it has been an important thing. Like, we all are working from home, and it has impacted a lot of our clients as well. So I guess there are two queries in this. So one would be, if your employee is temporarily working out of state, out of the original state that he was working from, and he might be working from his home state. For example, I would say New Jersey and New York would be the best example, where offices are in New York, but the employees live in New Jersey. So that is one of the examples. So in this situation, the query would be, where would the payroll processing be done for that employee? Should it be done in the state of New York, or it should be done in the state of NJ, where he's currently staying and working from? The second query would be, for a New York entity, would the employee working in New Jersey create a income tax filing requirement? So there are about 22 states, if I remember correctly. There are about 22 states who have come up with this conformity and and they have come up and said that temporary changes due to employee presence would not create a nexus for payroll filing or for income tax purposes. Because this temporary situation is only till the time the COVID exists and not elsewhere. There is, I guess, just one state, which is Michigan, if I remember correctly, which has said that it may create, if your employee is working out of state, it may create an nexus for income tax filing. But like I said, there are quite a lot of other states which have not issued any guidance for this as yet.
Oh, wow. So Dharmesh, I mean, I can sense that as a definitely an area of ambiguity because the telecommuting employees and the taxation or the nexus requirement because of that. So when we get into the 2020 tax filings and when we request from the clients the information on the payroll, this year probably it's not just about where the payroll was processed, but I guess it's also about where the employees were actually located, and then to see how the states is looking at the nexus rules for those temporary states. I don't even know whether each state would have really defined what temporary really means, because the lockdown phase or the real closures of the offices was a 2-month, 3-month, 4-month phenomenon in the US. But now it has indeed become a business model wherein the employees are still continuing to be working from home. So whether that fits within that temporary definition or whether it exceeds that. So I guess a lot of analysis will have to be required around, the nexus when the taxpayers are into the 2020 tax filings. I mean, that's it from our side. I mean, thanks everyone for, attending this webinar. And if you have any questions, please feel free to write to us. We will be more than happy to respond to your questions. And probably if you get some more insights, because it's a moving target. So if you get some more insights we'd like to share with us, we would be happy to learn them from you. On that note, I once again thanks everyone for attending this webinar. We really appreciate your presence. Thank you.
Thank you.
Thank you.